So, how is inflation a tax? Well, to understand, we need to delve into how the government obtains money to spend. You see, the government operates differently from individuals like you and me. It doesn't earn money by producing and selling goods and services at agreed upon prices. Instead, the government has three primary methods of acquiring money: taxation, borrowing, and printing. Taxation is the most straightforward method to comprehend because we all experience it. The government charges us money for earning income, spending money, owning property, or even unfortunate events like the loss of a relative. If we don't pay our taxes, we face fines and, in extreme cases, imprisonment. Another way the government can acquire money is through borrowing. This is done by issuing bonds. When someone buys a government bond, they lend money to the government. In return, the government promises to repay the borrowed amount along with interest in the future. The accumulation of yearly deficits and the national debt arises from this practice. Lastly, when a government uses paper currency, it can spend money simply by printing more of it. However, the process is a bit more complex. The US government doesn't directly pay its bills with freshly printed dollars. Instead, the Federal Reserve, the central banking system, purchases government bonds from private organizations such as banks using money that it essentially creates out of thin air. But how does this money creation generate revenue? To grasp this concept, imagine having the power to create your own currency and use it exclusively to buy government bonds. Would you do it? You would if you wanted a substantial amount of money and didn't mind the adverse effects it may have on others. Remember, government debt pays interest. So when you buy bonds with newly printed money, you're essentially trading the money you created for an asset that generates more money. Here's where it gets interesting. While the government is the one paying interest to the Federal Reserve, the interest, after deducting some costs, is historically returned to the U.S. Treasury. In other words, the Treasury issues a bond, the Federal Reserve purchases it from the lender, and then returns all the interest payments to the Treasury. This arrangement can be seen as an interest-free loan that the government grants itself, made possible by the money creation performed by the Federal Reserve. But what about inflation? Well, inflation and money creation go hand in hand. When the supply of any good increases, its price tends to decline compared to if the supply remained constant. Money creation leads to a relatively higher rate of price inflation. This is why economist Milton Friedman famously stated that inflation is always and everywhere a monetary phenomenon. When the Federal Reserve purchases bonds from banks, it provides them with newly printed money. As this new money circulates and is spent, it gradually increases the prices of goods and services along the way. This process further benefits the government because as inflation rises, the real cost of debt decreases, since the nominal balances remain the same. In summary, inflation can be seen as a hidden tax imposed on the economy. It occurs when the government, through its various methods of acquiring money, increases the money supply, leading to rising prices and reduced purchasing power for individuals. So next time you hear about inflation, remember that it's not just an economic concept but a form of taxation that affects us all. Subscribe Libertarian Facts.